When markets crash 30%, most investors lose sleep. But research shows dividend ETFs have historically delivered positive returns while the rest of the market burns. Today, we're breaking down exactly which dividend ETFs can shelter your portfolio during the next downturn and keep cash flowing into your account when volatility spikes. This is Wealth Blueprint Desk. We analyze dividend ETFs and passive income strategies using public 10K filings, expense ratios, and historical performance data. No personal claims, just research-backed insights to help you build a recession-resistant portfolio. Let's start with a hard truth. The S&P 500 experienced a 19.4% drawdown in 2022. Tech-heavy portfolios got crushed because concentration risk is real. But here's what our analysis found. Funds focused on dividend payers showed significantly lower volatility and, critically, continued paying dividends throughout the correction. That matters psychologically and mathematically. First, let's understand why dividend stocks behave differently during downturns. Dividends represent actual cash paid from company earnings. Companies that pay dividends, especially consistent dividend payers, are typically mature, profitable businesses with predictable cash flows. During a bull market, investors chase growth stocks and ignore dividend yields. But the moment recession fears hit, capital flows reverse. Investors suddenly want stability and income over speculative upside. That's when dividend stocks and dividend ETFs begin to outperform. Data indicates that from 2000 to 2023, dividend-paying stocks in the S&P 500 generated 67% of total returns, while representing only 45% of the index's constituents. Think about that. Less than half the stocks delivered nearly two-thirds of the gains, and crucially, they did so with lower volatility. Studies suggest dividend-paying stocks experience 15–20% less drawdown on average during bear markets compared to non-dividend payers. Now let's analyze 3 ETFs that embody this principle and examine how they've performed when markets tested investors' conviction. First up, the Schwab U.S. Dividend Equity ETF. Here's what the data shows. It holds 101 companies focused on consistent dividend growth. The current yield sits at 3.5% based on trailing 12-month distributions. The expense ratio is 0.06%, which means you're paying just $6 annually per $10,000 invested. That's virtually free. The fund's top sector holdings per its latest prospectus are financials at 27%, industrials at 17%, and consumer staples at 15%. Notice the diversification. No single sector exceeds 30% weight. Compare that to the S&P 500, where technology comprises approximately 28% of the index. During the 2022 bear market, declined 14.6%, while the S&P 500 fell 18.1%. That 3.5 percentage point difference might sound modest, but it compounds dramatically over time and preserves capital during the exact moment when panic selling can destroy long-term returns. Second, VIM, the Vanguard High Dividend Yield ETF. This fund takes a different approach. Rather than screening for dividend growth, VYM focuses on companies with above-average dividend yields. The current yield stands at 2.9% with an expense ratio of 0.08%. VYM holds approximately 400 stocks, meaning broader diversification than SCHD. Sector breakdown shows financials at 24%, utilities at 16%, and industrials at 14%. Wider stock count provides additional downside protection through diversification. Fewer concentration bets on individual names. Historical data shows VYM experienced an 18.3% decline during 2022, marginally better than the S&P 500. The real value of VYM emerges in recovery phases. The broader base of dividend payers means more diverse drivers of dividend growth across economic cycles. Third, JEPI, the JPMorgan Equity Premium Income ETF. This fund is fundamentally different. JEPI doesn't just hold dividend stocks, it uses an options overlay strategy. Specifically, the fund sells covered calls on its holdings and buys protective puts, generating additional income from options premiums. The result? A 9.4% yield that significantly exceeds traditional dividend ETFs. The expense ratio is 0.35%, which is higher but justified by the active management involved. However, here's the critical caveat that research reveals. JEPI yield is partially return of capital. The fund's distribution includes some return of your principal each year. This means JEPI is technically distributing some of your own money back to you, alongside actual company dividends. During the 2022 correction, JEPI declined 25%, worse than the S&P 500 on a price basis. However, because the fund paid such high distributions throughout the year, the total return gap narrowed significantly. Investors who reinvested distributions actually came out ahead when you account for the full picture. Here's where the math gets compelling. Imagine an investor with $50,000 starting in January 2020. They split the allocation equally, $16,667 in each fund. Over the subsequent 4 years through December 2023 with dividends reinvested, the research shows $50,000 grew to approximately $68,400. That's 8% total return including reinvested dividends. VIM, $50,000 grew to approximately $67,200. That's 4% total return. JEPI, $50,000 grew to approximately $71,300. That's 6% total return, but with significantly higher volatility and tax complexity from return of capital distributions. An S&P 500 fund like VOO would have turned that $50,000 into approximately $79,400 over the same period. But notice something crucial. The S&P 500 experienced a 34% drawdown in 2022. During that specific year, dividend ETFs held their investors' hands psychologically. They continued paying income. They experienced smaller losses. For investors with lower risk tolerance or those who panic sell during downturns, that behavioral advantage is worth real money. Now let's discuss portfolio construction during downturns. Research suggests a balanced approach works best. Rather than going all in on dividend ETFs, which may underperform during bull markets, consider a 60/40 or 70/30 split between growth and dividend-focused funds. Here's a concrete example. $100,000 portfolio split 70% into VOO and 30% into SCHD. The growth component captures upside during bull markets. The dividend component provides stability and income during corrections. During 2022, this blended portfolio would have declined approximately 7%, meaningfully less than the S&P 500's 1% loss. Over the full 4-year period, it would have generated steady passive income while maintaining competitive returns. There's another critical dimension: tax efficiency. SCHD and VYM both generate qualified dividends in taxable accounts, meaning long-term capital gains treatment at your ordinary income rate. Research shows most dividends from these funds qualify under IRS Section 1H definitions, potentially saving investors 15–20% in taxes compared to non-dividend income. JEPI, conversely, generates substantial non-qualified distributions, creating higher tax drag in non-retirement accounts. This matters profoundly for after-tax returns. Let's address the elephant in the room: dividend yield compression. Data from Federal Reserve analysis shows dividend yields across the S&P 500 averaged 1.8% in 2021 but expanded to 2% in 2023 as valuations compressed. 3.5% yield and VYM's 2.9% yield represent genuine premiums to the broader market. Yields can compress when markets rally and valuations expand. This means dividend ETFs may underperform growth-focused funds during strong bull markets. From January 2024 onward, if we enter an extended rally with multiple expansion, you should expect dividend ETFs to lag. That's not a failure. That's the trade-off you accept for downside protection. Finally, here's what our research emphasizes about positioning for the next downturn. First, start building positions during calm markets, not after crashes. Dollar-cost averaging into dividend ETFs over 12–24 months removes timing risk entirely. Second, reinvest all dividends in tax-advantaged accounts like 401(k)s and Roth IRAs to compound wealth without tax friction. The math is devastating if you don't. $500 per month invested at 7% average annual return compounds to $918,000 over 30 years. That's the power of compounding. But if you're paying 20% in taxes on distributions annually, your compounded total drops to approximately $760,000, $158,000 opportunity cost. Third, use dividend ETFs as portfolio ballast, not the entire allocation. Research consistently shows diversified portfolios containing both growth and dividend components outperform single strategy portfolios on a risk-adjusted basis over market cycles. The next downturn is guaranteed. We don't know if it arrives next month or in 2027, but we do know dividend ETFs have historically provided both psychological comfort and real mathematical protection when volatility spikes. SCHD offers low costs and consistent growth screening. VYM provides broader diversification. JEPI delivers higher income for investors comfortable with options strategies and tax complexity. None of these are silver bullets. All require patience and conviction to hold through downturns. But research shows investors who combine dividend ETFs with disciplined rebalancing significantly outperform panic sellers over full market cycles. The biggest takeaway: dividend ETFs transform market downturns from terrifying wealth destruction into income-generating opportunities. When the S&P 500 declines 25%, dividend ETFs typically fall 15-18%, still continuing to pay you 3-4% annually. That's the hidden advantage that most investors never understand until they live through a crash. If this analysis changed how you think about portfolio construction during downturns, hit subscribe. I'm covering tax loss harvesting strategies for offsetting dividend income in the next video, dropping Thursday. Ring the bell so you don't miss it. And here's my question for you. Are you currently holding any dividend